Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants. This podcast is for entertainment purposes only and is strictly not intended as financial advice. Any opinions are general in nature and do not take into account your personal circumstances, needs, or objectives. Securities mentioned are for illustration purposes only, and this podcast should not influence investment decisions. You should read the relevant PDS and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future returns. Podcast guests and their clients may hold positions in the securities discussed in this podcast. All right, we're live. Just me and Andrew today. We've got a couple of companies to talk about that one that Andrew's just met with at Strawman and one that we've held for a while. But first, maybe we'll do a bit of some good news. I don't know if it's all good news. It's kind of techie news. Apparently, the global Ozempic shortage has been fixed by a cheaper, faster method of production that produces 10 times more. Okay. I guess whether you like Ozempic or not kind of depends whether you think that's good news. But good news over.
Clearly, someone likes it, right?
Yeah. A lot of people like it.
Yeah. It's catching on.
The easy solution. I was chatting with our mutual friend Ian Castle the other day of Microcap Club, just around there's like talk that there could be a solution for Alzheimer's through like diet and exercise. And basically just that if you introduce enough diet and exercise, you could, maybe prevent Alzheimer's. And people were talking about that as like a negative for the Alzheimer's drugs. And I think he was just saying like, just look at the way people live. Like that's not how the world works, like there's a pretty big intervention to stop obesity and the obesity drugs are, flying. So I think having an easy pill solution is people like it.
It was funny you mentioned that. I was speaking to a doctor friend recently and he was saying, 90% of my consultations basically say you should just eat a little bit better and exercise a bit more. Now, not go on some weird hardcore diet and hit the gym for like 8 hours a day. It's like the incremental gains from that are massive. And it's like, yeah, but is there a pill I can take? It's just always the follow-up. And it's kind of like, well, there is, but there are always side effects, with all of that kind of stuff. And we're really just trying to treat these things will just treat the symptoms. Like you can like fundamentally address this. And it's one of those things where it's kind of like, this will address the problem that you have and 10 other problems that are developing right now. Like,
yeah.
We all know it, but humans are humans, right? And I'm far from like a bastion of like, pious dieting and exercise, but it's pretty obvious when you think about it.
Yeah, I know Claude always teases me for wanting to live forever on this podcast, but I did recently read the Outlive book by Peter Attia. And one thing that has stuck with me is, I might have mentioned in the podcast I can't remember, a month or two ago, but if you're in the top quartile of exercises versus the bottom quartile, your chance of death from all causes, you're basically 410% less likely to die in a given year.
Wow.
From all causes. 410%. And like the effect size of processed food is about 17%. So if you don't eat any processed food, you get kind of like a 17% bump. But being in the top quartile, just like the top quarter, most health, exercise versus bottom is 4 times. Like it's such a huge effect size. Yeah, I kind of get now why it's like such an obvious thing that's always suggested, but you're always like, yeah, whatever, where's the pill?
Yes.
Yeah, I kind of weigh that up. Whenever you read about any new study in the media or something like eat dark chocolate to be healthy or whatever, it's like, is it going to be 400%? Probably not.
Yeah, exactly.
Yep,
did you see that thing I sent you as well? There was some new 3D printed metal fabrication process, which is super fast, super versatile, super cheap, can be fed direct with just wire. Works on like 4 or 5 different types of metal types. Did you get that? I
don't know. I don't know if you did send it. Maybe I missed it. So tell me about it.
Yeah.
So
look, I'm not going to be able to break down the details. We've had the ability to 3D print metals for a time, but this is apparently a big game change in terms of the cost and the speed and
this was the Brian Romel tweet or whatever. Was this what you're talking about?
Yeah, he's got some interesting stuff actually. I'm not sure if all of it is sort of legit, but there's a lot of forward-looking stuff in there. But this is actual footage of some of the stuff being made there. It's just really, it's really cool. It's one of those technologies that's sort of been out there for a while, but if you haven't, and I haven't looked at it for a little while, you just realize that wow, it's really coming along. Like it used to be pretty dinky and limited and whatever, but it's you can imagine with another, I don't know, order of magnitude improvement again in sort of costs and speed, fidelity, etc., that it just sort of becomes potentially a technology that replaces a lot of other existing technologies.
Yeah.
So yeah, it's cool.
It's funny how, the first pulse of that 3D printing just got it wrong, right? Like it thought everyone would have 3D printers at home and you'd print your shoe. And the economics really never made sense. But just because it's so cheap to buy, like to mass produce a shoe, for instance, and you don't actually need that much customization.
Yes.
But then we'll get into this age where it's just kind of quietly in the background started replacing a lot of manufacturing and like precision manufacturing. I think we've chatted about it before, but like the AI generated parts, which are like super weird looking, like something that you'd never design with like, to be, like a cooling system or something where it's just it looks really organic. It's like how a plant grows in itself, like a vine or something, like all these pathways you'd never plan because we like normal straight lines for most manufacturing, but you can kind of do anything with 3D printing.
And not just the design, but like, how do you make that with traditional approaches? It's sort of like,
exactly. It's like impossible, impossible to make otherwise. I think that's really cool. Yeah, FDA approves Wegovy to reduce heart attack and stroke risk. That's another GLP bit of good news, I guess.
Okay, take that.
Doctors can now edit the genes inside your body. It sounds like science fiction, but dozens of people have undergone gene editing for cardiovascular disease and other conditions. We talked about this in the pod before. I guess it's getting mainstream attention. I think that's going to be the biggest shift, one of the biggest shifts in human history is happening in our lifetime, which is editing the genes that a living person has. As I've said before, everyone thinks of like Gattaca and designing babies, but it's more about like you, Andrew, deciding to upgrade your genes. Maybe you want blue eyes or something. I don't know. But like, it's not even crazy to say that you could change eye color, right? Like, because that's actually probably one of the more
I'm not going to knock
traits.
with perfection, Matt.
Nice. Still got it. But yeah, being able to upgrade. I mean, yeah, there's just so much stuff. It'll be fascinating.
Yeah,
it's actually happening. It's kind of happening in the background very quietly now, where it's like I feel like that should be more news. But anyway,
there's like 10 different cutting edge techs that seem to be like that, just bubbling away. Again, we've sort of, I've mentioned this a lot of times before too. You've had the 0 to 1, and it gets the attention then, and then it goes out of focus. But you forget it's like no, development is still happening there, and progress, like real progress, is being made. So exciting time to be alive.
100%. All right, well maybe we should jump to some news. Unless you had anything else on good news or macro related stuff.
No, look, the only macro stuff is that, it's as always the focus on interest rates, and, now it sort of looks like the
So you're a homeowner now.
Was certain
you suddenly think they're about to fall and should fall immediately. Is that right?
It's outrageous that the government doesn't do something about interest rates. Let's just say they need to put them down right now.
Yeah, I mean, I guess it seems like there's some signs of sticky inflation. There's lots of signs that it could be a bit of a pulse, from even just shipping costs have increased quite a bit from all the Houthi attacks and things. Oil is creeping back up again. So yeah, I think that we've had this wave of disinflation from all the goods kind of going post-COVID. You have like this whipsaw effect, and we're kind of been in the downs of all the goods prices coming down, but that's kind of stabilized. So goods prices won't just keep falling forever. At the meantime, kind of core services are still going up quite strongly, kind of at the 4 to 5% level. So yeah, that's kind of my pick, is a bit higher for a bit longer at least. And then we see what happens after that. Yeah.
I mean, again, I think the commentary tends to be pretty myopic on interest rates. People have their pet sort of factor that's at sort of play there. And my view of it is it was when we had that real run up there for a while, it was a combination of supply shock issues combined with a lot of extra money sort of sloshing in the system, and a lot of the supply chain bottlenecks, as you say, some of them are sort of resurged a little bit, but they were always going to resolve themselves with time. There was nothing sort of permanent to those kinds of features, but the other problem hasn't gone away. And yeah, I particularly with a Fed target of 2%, that just seems like a long way off. So yeah, we'll see what happens.
It's weird when America's still, the deficit spending still so insane over there as well.
$1 trillion added in debt in the last 100 days. I think they're on pace to sort of like that half-life, if you want to put it that way. That doubling time is just, or not doubling time, that threshold of 1 million added is just getting shorter and shorter and shorter. And the thing that's fascinating about that is that this isn't wartime spending or, emergency sort of spending.
It's boom time spending. Yeah.
It's just boom time, and it's structural.
It's boom time while we're simultaneously trying to cool the economy with interest rates, right? Like it's kind of wild.
Yep.
Yeah. So yeah, in 2023, it was 6.3%. The US government spent $1.7 trillion more dollars than it took in tax, which is extremely stimulatory. Like if you did that each year, you should be growing by like 6%, basically.
Absolutely. The government spending as a proportion of GDP in the US is, I'm going to make this up, but the the general ballpark is, I want to say, sort of like around 25%. Like it's
Yeah.
a very significant contributor.
By the
So
way,
yeah,
in Scandinavia, it can be like 40 to 50%. So
yeah.
but obviously they're not as big. All right, I think the same on the macro. So
Yeah. I
we'll
mean,
leave
what do
that
you
one
do?
there. Yeah.
Yep.
All right, maybe jump to, you've just met with him as Strawman. Give us a breakdown of, I just talked about how to pronounce it. ImExHs, is that how you
I think
pronounce it?
so. Yes.
Okay,
Yes.
cool.
ImExHs, or the ticker is
Mm-hmm.
IME. Yeah, I think. Well, yeah, we just this morning spoke to Herman Arango. He's the CEO. He's the founder. He's a radiologist. We've spoken to the team a couple times before. They report on a calendar year basis. So this is the one that'll always be contrasted with Pro Medicus because they do medical imaging software solutions. The main difference being is that they have a very core focus on Latin America and emerging markets. So it's somewhere where they've got, Herman said, around 15% penetration. I think that was just in Colombia and its largest market there, but it's still a long way to go. And yeah, like they listed in 2018, the revenue's been growing pretty strongly. And I think it's interesting in the last little while, they've kind of pivoted to this EBITDA positive sort of basis, this positive operating cash flow. They did a tiny capital raise recently for working capital purposes, $1.5 million. But they're sort of, his view is like, yep, we're standing on our own 2 feet now. We've put out some pretty strong forward-looking guidance for the current financial year. Yeah, here's the dilemma, I suppose, for someone who's interested in this space. It's sort of like, is it as good as Pro Medicus in terms of the opportunity, the client base,
Claude
everything
somewhere
else?
out there just felt like
But yeah, he's
trigger.
the hairs on the back of his neck.
Hairs on the back of his
stood
neck
up.
stood up.
And I want to be the first to say, all right, like given the choice, like Pro Medicus, right? The difference is Pro Medicus is on a P of 160 or something. These guys, they're trading at basically their ARR, right? So the question is, I suppose, is there room for more than one player? There usually is.
Yeah.
Is this an area where Pro Medicus is focusing? No, it's not. It's a different tier of customer. Is there enough opportunity or within the niche that ImExHs operate in to continue to sort of grow at that pace? And I don't know. It feels as though I'm coming around.
So what would you say what's a forward multiple comparison? So Pro Medicus would be like 160-ish. What do you reckon these guys are?
I don't think they've got a net profit figure, but
Okay.
they're about 25 million in market cap. They're doing about that in ARR.
pretty different. I mean,
It's
multiple of
different.
ARR, if you compare that, I guess 1 times ARR versus, I don't know what Pro Medicus would be, but many times.
It's more, right? And so that's the dilemma. It's just like, is it higher quality at any price, or does it even have to be 2? I guess it does. It's a false dichotomy to some extent. And look, to be clear, I don't have shares. I'm not in a position to be buying shares anytime soon anyway with the capital allocations I've made. But I guess I can see a reasonable case for it. And there's something to be said when you've spoken. This is the 3rd meeting we've had over 3 years with the company, and you pay attention when companies sort of say, hey, we're planning on doing this, and then they do. Like every company tells a good story, but they've pretty much been on the money in terms of what our focus is, what we're going to do, what we've delivered. I think probably statutory revenue growth was a little bit disappointing in the current year, in the year just ended. But yeah, it's hard to fault them too much. So I think it's interesting. Have you ever had a look at it?
A couple of years ago, basically. It's probably on the small side now, but yeah, I guess talked through it with Claude, who you might imagine compared it to Pro Medicus and wasn't too favorable towards it. But yeah, you're right. It's like a different business, right? You don't have to, not everything has to be that. It's different business, different areas, same industry, but like different kind of parts of the stack that they do as well, right?
They're doing outsourced radiology services and that kind of stuff as well. For a lot of these under-resourced geographies and stuff, and again, ones that don't have big health budgets, there's a pretty compelling value prop that's in that. And I guess they're not likely to be Pro Medicus clients anytime soon.
Yeah, I guess my thoughts at the time were it seemed a bit more asset intensive. Like they were doing more stuff, I guess, by putting like machines in and etc. Which when you combine with not being profitable, it just means, I guess, the path out there to like profitability is, slower, and there's less of an inflection pointy kind of moment where you have software like comes through and breaks into profit and then super high margins. So that's kind of combo is where I left it. And it was always quite small and illiquid at the time I was looking at it. But now it's probably even cheaper now and seems to have kept making progress. So Yeah.
Shares haven't done well. Well, I mean, and I'm very sort of squint and stand back a little bit. It's kind of been flattish for the last couple of years, but yeah, I mean, I actually put that to Herman. Why? What do you? He doesn't know, right? Any better than the rest of us can speculate. It's like, why do you think that is? And his view was just like, I think the market was waiting to see sort of profitability, and they're waiting to sort of see if it's sort of sustainably sort of so,
Yeah.
which is probably a fair interpretation of it. So
Yeah.
I suspect it's one of those ones that, I mean, this might be a big if. Everyone will have their own view, but if they do continue to sort of see those operating margins sort of expand and fund their growth completely organically and continue the top line sales traction, I could see a re-rate. Like I really could. That's kind of probably core to anyone's thesis who's looking at this thing. Can they do that?
Yeah, I mean, I guess over the last couple of years, they've got trapped in that, everything needs to be profitable kind of thing, right? And if they'd been building a business where they're still losing money, I've seen this in a few of them where it's just like, you kind of get stuck in that no man's zone where it's like, oh, what? We're doing profits now?
Yes.
A lot of businesses, So yeah, I think that, and then trying to pivot that at the same time as growing, because you need to be showing growth. Otherwise people lose interest as well. So I think that that combo has caught out a few businesses.
100%. And that's always the hard thing for us as investors is trying to recognize, okay, you've had some good growth today, like at the top line, but how sustainable is that with a lower resourcing? Do you know what I mean? It's just like, it's hard to have a favorable interpretation of it because it's either like, well, they can't, in which case, why have you cut for? Because that's handicapping the business, or you can, which is just a reflection on earlier extravagance perhaps in cost base. But at least, if that was the case, it's always better to sort of recognize and correct a mistake than to continue to barrel ahead. But in a lot of companies, I feel that we've spoken to are too accommodating to the demands of analysts. Do you know what I mean? In the sense that the people running the show here, they're not idiots, and they're picking up what the market is telling them through analysts and fund managers, all these meetings that they sort of have, and we really need to see this, and they go, okay, we do that. And it's sort of like, I guess to some extent there is a reality of keeping the investor base happy and giving the market the narrative that it wants. But I wish there was a little bit more independence of thought and strength of character from the leaders to say, look, like us or don't like us, it's up to you. We're doing this, and here's the rationale for doing this. And if you're not on board with that, that's totally cool. Now, that's a very bold thing to do, and usually you can't always do that, particularly unless there's a lot of inside ownership or something. But do you get what I'm saying there? I feel as though it's sort of like, oh, we're doing this because this is what the market wants. Oh, now the market's decided that this is the focus and we need to do this. And now the market's talking about AI, so we're doing this. And it's more about being able to put out a narrative rather than sort of strategically thinking about the business and what it looks like in the years ahead.
Yeah, I think that can be that's a very fair criticism, right? But yeah, I guess there's a lot of companies do that. They respond to the capital markets. We kind of are looking for these companies that are, what would you say, like iconoclastic or like non-consensus, but right, they don't care about the market's view of things. They have a view of how things should be done. And yeah, I like that. That's generally what I tend to look for as well. Like you can get too caught up. I think it becomes like a self-referential loop or something when companies try to like do what they think the market thinks they should do, and it can go pretty badly.
I'll give you another example. We spoke to IDT, sort of one of the pot stocks actually, and they actually seem to be heading in a reasonable direction. But the CEO there mentioned that they want to start paying a dividend, and I got a bit of a sense that was more because that'll be good for the share price rather than is this the best use of capital? Do you know? Like that's another classic one. And I kind of tried to sort of say, well, dividends are always nice, but if you've got a reinvestment opportunity there, don't give us, like, no one's buying a pot stock for the dividend, right? Like, I do flip flop a bit on that one, because the good thing about a dividend in those scenarios is that it does put more restraint on management's capital allocation decision. When you've dividends tend to be sticky. It's hard to sort of introduce them and then pull them away. So once you've at least got that commitment there, you've got less money burning a hole in your pocket, money that may otherwise not be invested well. So, there's pros and cons, I guess.
Yeah, I think that's fair. Yeah, I don't have too much more to add, I guess. Should we move on to another company that is a bit more iconoclastic?
Yes.
A little bit, at least. RPMGlobal, which is one that I think we talked about before on the pod. I haven't talked about many stocks that we own.
We have.
In the fund. But yeah, we talked about that one before. And I think it's continued to own it, have owned it for many years now. And I think the recent results, we hadn't really chatted them through on the podcast yet. But yeah, so RPM Global kind of described it, management team, Richard Matthews, the CEO there. I kind of think of him as like the founder. He joined the business, he bought shares on market and then joined the business and became CEO many years ago when it was more like an advisory consulting business, and really lent into the software that they had and then kept reinvesting. So he's kind of, I guess his, super skill is capital allocation, and he's just made a series of smart acquisitions of other software companies and then continued to develop their own software to the point where they've got quite a complete stack of mining related software, particularly for open cut mine. So mine planning, asset maintenance, a whole raft of different things that they help miners do. Yeah, so anyway, and the most recent results, here's saying that it was their best half in terms of revenue and profitability in the history of the company. There was revenue growth of 20% over the prior year to 56 million, and software division grew 26%. Even advisory, which is kind of that kind of legacy business of like consulting, grew by 15%, kind of a
15.
A busy time. There was some one-offs in here. So there was particularly one-off of software royalty payment of 3.1 million, which you wouldn't expect to repeat. But kind of even stripping that out, there was a lot of operating leverage. So in the first half of 7.5 million of profit, which is growth of 331%. That's including that one-off. But either way, a lot of operating leverage starting to come through. And I think if there's one part that the market seems to have really liked, it's that demonstration of operating leverage. And it's something that RPM's done pretty well, is they've transitioned from, I guess, first an advisory business to a software business, but then from a traditional software business where you sell what they call perpetual, like one-time big lumps of software, to a subscription model. That in itself, that kind of hurts your revenue when you do it, right? So say that you're selling, how would you say it? Say that you're selling 50 million of perpetual software in a year, and the next year you went to selling subscription. Maybe you sell a subscription instead for that same amount of like, say, $15 million a year. It takes a while to build back up to the point where you're selling more software than you did before when you were selling perpetual. It's not quite that stark.
It's a hard decision to make because it's better quality revenue, right? But you're going to take that short-term to medium-term hit.
Yeah, exactly. It's better quality revenue. It's better for the customers because they have a product now that's live and that you're updating all the time and can push out updates. So there's lots of advantages to it, but it means you have to take this hit. And so they've kind of gone through that over the last few years, and partly because they had these other divisions like advisory that were ticking over profitably, but they were able to do it without really, making big losses. Kind of floated around break even. Every now and then they might report a profit, but now they're kind of through that phase. That build work is largely done, and they've been signaling for a while. And I think this was the first half where the market really started to pay attention, but kind of signaling, hey, we've built out a lot of stuff now. Now we see it kind of consolidating and selling what we've got. Yeah, we expect a lot of profit to flow through, basically. So if you keep adding, $10 million of subscription revenue roughly a year, and then a lot of that, it's very high margin revenue, it might be 80% plus gross margin that flows through into a lot of profit gains. Yeah, it seems like it's starting to come to fruition at the moment. And I think it's kind of what got people interested.
Yeah, I know it's a company a lot of investors I respect have liked for a long time, and it seems to be playing out as according to the thesis. But as you said, you've held it for a while. It's been a journey, right? I think shares are at record highs now, but it kind of had this big sort of U shape there for a while.
Yeah.
What do you think that was a case of the market running too far ahead too early, or was there any sort of missteps in your view in their execution, or just took longer than they thought? Or what's your analysis there?
Yeah, I mean, I think it's similar. Like it was still a software company, right? So like the last time it was a bit below these prices, at the end of 2021-ish, kind of got hit with all the others in 2022. I think that there'd been some times along the way where they'd made some missteps where they given guidance and then maybe something changed and then they struggled to hit guidance. Like they put out a big guidance number that everyone's like, wow, that's really big, and then kind of struggled to hit it versus going the other way. And this year they've upgraded guidance like 3 times. And so I think they've learned that lesson. So I think some of it could be that, but I think it's also just the market. Yeah, market's starting to pay more attention. It's also been mining software. It took a while. There was that kind of ESG frenzy, I guess, where anything related to that was seen as going away immediately. And I think as we were thinking at the time was like, you still need to mine all the minerals for the green transition, right? Like it just seems crazy. So I think that's actually, that penny's kind of dropped as well. So if it was in the penalty box, And I think it really was because they sold off their coal, and they had another small division which did coal testing or coal gas testing. And they sold that off partly because they wanted to be more pure for kind of like investors who are, nagging them about ESG concerns. So it's just kind of funny. I think it's kind of in the last couple of years gone full circle on that. But I think the other thing that's happened, we were just chatting before the pod, is it had this like loyal ownership base, I guess, from some individual investors and fund managers, but it didn't, it had all the investors that it had, and there weren't any more coming along, and so the share price was just kind of at where it was. And now I think there's some more overseas funds showing interest that have been buying, and they kind of look at it and go, actually, this thing, it looks really cheap to us compared to other stuff. It's growing, it's past profitability, etc. So I just think it's interesting how you need those new investor cohorts really, or you need something to change to actually get things moving, basically.
We chatted a bit off air about this, which was the idea of flows are so impactful, right? Like, and you as you say, a lot of loyal shareholders there, but with their full allocation, it's like they can like it all they want. Unless they're putting fresh money to work there, I need a new cohort of capital to come in to sort of, or at least bid high enough to tempt other existing holders to sort of let go of their shares. And it's sort of, it shows you the importance of not just being right, but knowing that other people are going to see that you're right in time, because otherwise you can be right all you like, but if you're right by yourself, then that's it, right? Nothing's going to happen. But weighing machines, voting machines, all of that kind of stuff, and it's just great to see it play out, man. So well done, congrats.
Yeah, thanks. It's good to see it. Good to see it come back. I think it could still have, it could just be getting started if it can keep adding. I think it could. They talk about potentially having 100 million of software revenue, so per year. So that would be, if you get that and you're going to kind of flow that through the kind of operating leverage they should be able to get, I think it could have quite a bright future ahead. It is very lumpy, so this half tends to be when they sign all the contracts. Everything gets signed, so this kind of next 3 to 6, next 3-4 months, really, I guess, in the calendar, we'll kind of see how much they deliver. But I think they should just be able to keep ticking along. And I guess the other thing, one of their products that hadn't been as successful before, Execute, is starting to find its feet, and mentioned it could be tipping into a bit of an inflection point. So a few good things there.
Is your sense so in terms of the investments that they've made and the transition to the sales model, is the next few years just leveraging that, executing that, or is there any more adjustments to be made?
Yeah, I think it's leveraging that. I think it could be some of the modules like Execute I mentioned might, if they kind of go through a period where they sell a lot of those things. There's still some potential for some bigger contracts that have been kind of on the horizon for a while, where like a global miner could roll it out to all their mines for some of their software. So I think that's probably it. I think it's just leveraging their cross-selling, leveraging some of the products that they have in their portfolio. I mean, they could always make another acquisition at some point.
Yeah, so it's an interesting setup when a company goes from a heavier emphasis on investment to an emphasis on execution. The first level view at this would be, you open it up on your broking site, you see, the last year it's gone from $1.40 to $2.30. It's they've had some good news, but it's kind of priced in. The PE's 100, I think, if I look at ComSec. But that misses the potential for that operating leverage that you were touching on before. And I noticed if I just like simply pro rata the half year result, the PE is actually like 35 or something like that. Do you get a sense there's still value there?
Yeah, I think I mean, first, what you're doing, just like looking at the forward number for the company, I think is always good, because it is just kind of in that tipping past that inflection point, right, where profits are going to be growing. You'd expect much faster than revenue, just because you add, say, 10 million of revenue to the top. That might be 10 million, roughly 10%. Say they're around 100 million. You add 10 million of revenue, but it's super high margin software revenue. You add then
with no additional fixed cost component.
Exactly. It becomes, say, 8 million of net profit potentially. And that could, if you're already on 8 million of net profit, say, in prior year, then that doubles your net profit in that year. So you go like 10%,
which halves your
growth.
PE.
Exactly. And 10% growth is 100% profit growth. So that's what we mean, I think, just for anyone not aware, what we mean with operating leverage is just how much, when profits can grow much faster than revenue, because you have more of a fixed cost structure and you don't have all your costs increasing the same. So that's kind of that would be, I guess, their plan over the next few years. If you can keep adding that, I think it will just hinge on, can they keep adding, roughly, 8 to 10 million of software revenue, subscription revenue each year. That's very much what they're planning to do, and like all their guidance is towards that. They think they can keep doing that. They do need to keep selling. They do need to keep winning. If you keep doing that, then I think that kind of multiple takes care of itself quite quickly over the next few years, just because it's, they are really quite sticklers on costs and everything else. And I think that's when we talked about the people that owned it before, I think it had really resonated with kind of more value focused investors who I kind of joked as like everyone's first growth stock kind of thing, because you see like a lot of value guys who buy it and it's more like maybe their first tech stock, because it was always more kind of focused on that. And even a few years ago they were talking about kind of finishing up and trying to get operating leverage then, and at the time I was just like, why would you do that? Like, you have so much opportunity to keep growing. And I think now they've kind of struck a good balance. So yeah, I mean, I personally value with a discounted cash flow. I think it's moved up a fair bit, but it's kind of baking in, a lot more than it was at $1.40, say. It was just a question of how much operating leverage can you get out and how much can that software grow? And then there could always be like a one big acquisition that could happen. And I guess the other point is that has always kind of been hanging out there with us is the potential for a takeover. When Richard Matthews talks about it, he wants a much bigger number. That's actually, so they've been buying back shares as well, I should mention. They bought back quite a good chunk of the shares. I don't have the number in front of me now, but I think he mentioned it on the call the other day. But a very meaningful percentage of their shares have already been bought back because he thought it was so undervalued, and they're still buying back shares today, kind of as a signal. But yeah, so you're getting, that's, I think, a sign of where the potential is, because I think they were worried at like $1.40 that they could be taken over too cheaply kind of in 2022 when everything got beaten up. And we've seen a lot of software companies on the ASX taken out. But their numbers they're thinking about is more like, $3 to $4 is kind of like $3 might start a conversation and $4 might be a better price, which obviously these are just random numbers, but be a meaningful multiple. You could, if you're holding this kind of waiting for those years of growth to kind of bring the PE down, that could kind of give you a return much quicker, as with a lot of these software companies. If they get taken out, you can kind of have it all compressed. Yeah, it's a nice upside. I don't think about it much, but it's a potential upside, I guess.
Yeah, look, it's nice to have. And I'll just double down on your comment before about the DCF. I think that's largely the benefit of the DCF is to try and sort of, you obviously want a number to be spat out at the other end, but I love how it forces you to think about the economics and the changes, particularly around those inflection points, and particularly as a business is in a scaling phase. Because if you're the kind of investor that, and I do this a lot, by the way, because I love the simplicity of it, where I just take an earnings per share, grow it, throw a reasonable multiple at it, and, come up with a future price target and discount it back. I really like that elegance of that. But it's always going to, these kinds of situations are always going to feel difficult to value that way, because you said before, it's like, a little bit of revenue growth and we could double the net profit. You're doing these analysis and you go, well, here's my model and I'm forecasting 100% net profit growth for the next 4 years. Just, it feels reckless. Like it feels well, it's, it feels reckless unless you've done the DCF work and you can sort of say, well, there are implicit assumptions in that they will keep costs relatively steady and growth in sales will maintain. But you can see the roadmap of how that is a reasonably still attractive, but much more modest top line growth can generate much more at the bottom line. So that's why for anyone listening who hasn't, because it is intimidating DCFs, but you don't have to do every line item in there.
No, I mean, I was just thinking as you're talking, it's basically you want revenue, gross margin, like some other variable cost if you can, and then a fixed cost. Like that, those are basically the lines that you need, and those are all the real moving parts. Because some idea of what their kind of fixed-ish costs, and those you shouldn't just assume they're going to be fixed forever, because no business is like that.
Nothing. No, it's impossible.
They don't step up as fast. I think that's how you can get it. And to your point, I think buying growing businesses that can still be undervalued, it's hard to do without the DCF, because you kind of need to think it's not really the next 2 years. Brokers are normally thereabouts of the next 2 years, but after that they're not normally, like they go wild. They can go too optimistic for sure too, but they don't tend to put much time into their forecast, because they're all thinking about price targets in the next 12 months and stuff. They are only really measured as the next earnings result accurate. There is some, they do try to do that well, and some of them do well. And I think David Gardner, Motley Fool, even talks about like, I expect them to always be better in the next year, but I'm thinking longer term. And so it's those longer periods of like sustained growth that often aren't priced in. Sometimes they can be, but that's kind of what the DCF helps you figure out.
That is, I'm repeating myself, I know, but the more I've thought about it, the more I've thought that's the edge you have as a private investor. Like that's the edge. Like if you think maybe that, or some domain expertise that you wouldn't expect the average analyst to have. But other than that, I think time horizon is is it, right? Because
Yeah.
the institutional imperative makes it very difficult for most sort of professional players to sort of do that. But with that though is also the very real challenge of looking further ahead, but also having the fortitude to stay with it, because you, even when it starts to play out, you go, oh, I'm up 40%. Look how clever I am. And it's just like, well, go back to your analysis here. Remember what the jaws are opening up here in terms of the margins. Like, you do not want to spend all this money, all this time, tie up all this capital, go through all that volatility, and then walk away with a 40-50% profit on something that is probably a multi-bagger over a 5 or 10 year period. And again, it's not the kind of returns that will be open to a lot of those institutions who will be reweighting and rebalancing and reforecasting every inch of the way. So, and I just, I'll congratulate you again, man. That's been absolutely the story with RPM Global. It's like, what was the thesis? This is it. Price is doing all this other kind of stuff,
Yeah.
When you look at the a year ago and before that, it's like, what a gift from heaven, right? And again, others would have been selling down because, well, next year's going to be tough because of this, and this. And it's sort of, when you stand back, it's like, this is a good thing. We should welcome it.
Yeah, 100% agree. I think that's, thanks, man. And I think that having management teams that you can build that trust in, that helps a lot, because it helps.
Yes.
I think a lot of that conviction you have during the tough times is often thinking, are these people really committed? Like we talked, Janison was one that had not gone well and we sold out of, and then it went, I think it fell like 50% more after we sold. So I felt very smart about it. But the CEOs, they like quit, like, you know what I mean? Like like a month and a half later, they just like, I don't know. I get, if you're a professional CEO, it makes sense. Like if you're in something where it's like things aren't going well, you need to move on to something else. Maybe there's pressure from the board as well, but it's, I don't know whether who quit or went in that situation, but compare that to an owner founder type mentality where it's like, things aren't going well. It's, you just have to figure it out. Like you're there, you know, like you're not just going to leave. Yeah. It's like marriage versus dating or something, maybe, I don't know, but it's like that commitment, you're committed to it. And I think that's what you want to see in the tougher times. Like someone you feel like you're in there with them, they've got your back and they're going to try and figure out a way to get out of it. So,
And also being cognizant of the reality of business. It's really hard. Not every decision is going to prove to be a successful one. I think we can have a pretty low tolerance to mistakes, and investors can very quickly jump from what may ostensibly be bad luck, bad timing, difficult environment to ineptitude or fraud in some instances. And it just, you notice that trend, like, oh, they said this and they did this, and like, oh, I'm never trusting them again. And it's like, well, really? I think anyone who's run a business has known that it's just like, even when
I think particularly so for like not meeting guidance, right? Where it's like the guidance is just a forecast, and imagine if you're in any business, you make a forecast and then something changes. I don't inherently see that as dishonesty at all. I think if you're saying we're about to hit our guidance a week before you massively downgrade, I think that might be dishonest. But if you like say something at the start,
or you've continually overinflated numbers.
Yeah, for sure. Like those are bad signs of dishonesty or ineptitude. But more often, I think just things happen. Yeah, I think that's fair.
Which is why, I mean, again, I'm not many people think this, but I really think what I want in terms of guidance is not so much, I just sort of want to be sort of directionally correct. And sometimes these forecasts made with the best of intentions and hand on heart, this is our best sort of guess, but then it does create a rod for your back where you put pressure on yourself. And when and then that pressure forces you to make decisions that otherwise, without that pressure, you might not have reached that harder, or, signed that contract at maybe not the best terms that you would have otherwise done it, or you brought orders forward, or you cut costs where you wouldn't otherwise want to do that. So it's sort of like, just any CEOs listening, and I'm sure half the ASX listens to our little podcast. Don't, just because the ducks quack, you don't have to feed them, right? Like you can be realistically vague in your outlook.
Yeah. I mean, I think the reason that RPM might have given guidance was because they had the sense that they could be taken over at too cheap a price, and like, hey, we are planning to grow, and we're going to, like trying to maybe do that. But it can easily become a rod for your own back if you aren't able to hit it, or just even struggle, or don't upgrade. Like as soon as it's out there, it means the market's then hungry for the next bit of news, right? Next upgrade. So I think, longer term, if you can, avoiding guidance altogether is often the best, and just delivering and building a steady business that can deliver, I think works wonders.
100%.
Maybe even dampening down when things get too excited can be useful as well. So I was actually listening to I think I'd listened to it once before, but it was the manager of the Norwegian Sovereign Wealth Fund giving an interview, and he has had a few really good lines from there. But one of them was like, all the money is made in non-consensus and right. Like if you think of the grid of consensus, non-consensus, right and wrong, like all the money is made in non-consensus and right. And yeah, you just need to focus like all of your time there basically. And it's always going to be a bit lonely, like if you're doing it well.
Yes.
And I think it's 100% true. And I think when we talk about like holding long-term multi-baggers, that kind of changes from that, right? Where things were non-consensus and right to being consensus and right. And you can still get good returns. But typically when you're honest with yourself, like the percentage returns aren't nearly as high, right? They're not nearly as high as at the start. You might make it looks bigger because you've kind of compounded, once you've had a 20 bagger, that it only 100%. Takes 10% to go to a 22, or like 50% return to go to a 30. And it looks really impressive if you hold something for 5 years and your 20 bagger becomes a 30 bagger, like, wow. But that's only a 50% return over 5 years. It's actually like pretty average, like in the market's return. And I'm not against that. I'm like, I like to hold winners and things, but it's just to keep in mind that as everyone starts agreeing with you on some, positions like Pro Medicus or whatever else, it's unlikely that that's going to be driving the same returns as it did the first 100%. Time around, like on a percentage basis.
I know you and Joe talked about it back in the pro days. It was sort of like that part of the process was, what's the variant perception? Like if there's not a variant perception, like it's kind of like you have to assume the efficiency of the market. And if you assume that, then you're assuming average returns definitionally. Right. Yeah. So it's kind of like, and that's super hard. And the other part of it is not just going against the crowd, but having the courage of your conviction. Because we all like to think that, so like as soon as you see that variant perception, it's like, oh, this is an opportunity, and you buy it, and you just assume that tomorrow is when everyone else the penny drops for, when it's probably like 6, 12, 18, 24 months away, like at best, before, if you're, again, assuming you're in the right quadrant, that the market goes, and then does it. So it's diabolically hard.
Yeah, man, I agree. And it's really strange. I don't know. I don't really have an easy way to measure it. I think you want to be careful you're not overthinking it as well by going like too many steps where you're like, I'm so much smarter than the market, where it's like, it becomes a really complex thesis, like, well, they'll do this, and then if they sell that division, and then they do this. When I went to the Berkshire Hathaway meeting, I also went to like a value investors meeting. There's like all these satellite meetings around Berkshire Hathaway.
Of course.
And there was this other value investing managers meeting, and it wasn't great, but the general theme was very smart people doing extremely complex calculations to just result in like a slightly decent return, like and this happens, and then they sell off this division, and then they go there, and then they expand this, and then we'll get like a 12%, 15% IRR or something. Like that's really complicated to get all those things done.
And it's worse than that too, because there's also, that's got to be put in the context of what's the downside. So it's kind of like a 15% return with very little downside is one thing, but like if my upside is 15%, but I can still drop 30% if the thesis doesn't play, I was like, that is really bad asymmetry.
Yeah, 100%, man. And then you've got like insurance brokers that are super low risk that tend to grow at like 10 to 15% a year. One of the least risky businesses, I think. I think that's a very fair way to think about it. There's a lot of ways you can like overcomplicate it, but having a variant perception is key, and you just want to be, one step ahead of the market, not like 15 steps ahead, or else you're too variant. The market will never catch up.
That's right. Yeah.
But yeah, it was a really good, I should actually try and find the link for that talk. Maybe I'll put it in the show notes or something, but he talked about a few other things in that one. It was also like all the different means that they had to get information. He talked about they used forensic linguists. Yeah, so Nikolai Tangent is his name, but he's forensic linguists to analyze transcripts. So these are people who normally analyze like criminal proceedings, like, ransom notes or whatever else, like just determine if someone's guilty or not. And they would analyze the transcripts and like figure out the point where the company was probably lying because they didn't answer the certain question or whatever.
Wow.
Yeah, pretty advanced. It's pretty like, yeah.
I don't want to segue too far. You reminded me then, I said last week I was playing around with Claude AI.
Yep.
And I've since like uploaded some transcripts from Strawman
meetings. Yeah. Okay.
You know, so hour-long meetings, right? And then you can just question. It's so good. Like I thought the CEO mentioned this. Is that right? Yes. At minute 42, it said this and that. I said, well, actually, what's changed? Here's the one that we did before. What's change there now? It just I can kind of see a bit of an angle there in sort of having an interpretation on the the linguistics and
Mm-hmm.
contexts and all, you know, the language sort of characteristics. But yeah,
Yeah, maybe I should try using AI. Maybe you could ask the AI, like, you are a forensic linguist. Can you like take a look at this? That's not a bad idea, actually.
Yeah.
Yeah, that's
I mean,
cool.
but to your point though, so I didn't mean to divert there, but the point being is like when you're like anyone listening to this, right? Like, are you going to employ one for your
No.
analysis?
Yeah.
Like, no, I'm not. Like, none of us are,
Yeah.
right? But it's sort of
Yeah.
like it gets to the point where it's like, what is the payoff versus the cost and effort in that? And it's like we're talking about something that could like be a 10 bagger in the next few years. Okay, that's worth the effort, but I don't know if you're really going to get that. You're going to divine that level of insight.
No, I think I was thinking of just trying to find some books on the topic though. Like I have done some like read some body language books, and there's definitely stuff that I pick up. I shouldn't give any more secrets actually, but you definitely
I'm
pick
just
up
going to
some
start
stuff.
looking very straight at the camera without any facial expressions.
And I used to play poker, and there's like poker towers that kind of carry over. But so I think there's something to, it's kind of like the 80-20 rule. Like you can pick up, 80% of, the expertise in an area in about 20% of the time.
Yep.
And I think that just going to 80% in a lot of areas, I think can be really worthwhile as an investor. So, especially for us kind of generalist guys and girls. I think that can be really, and just fun. It's fun to learn different stuff.
It's very Mungerish of you, actually.
Yeah.
I mean, that's what he was sort of saying. You want a reasonable grasp of, like 7 or 8 kind of disciplines will arm you extraordinarily well in handling the world.
Yeah.
I don't need to be. I don't need to be like Richard Feynman level physicist to sort of get some of the big ideas that sort of come from physics. You know what I mean? Like I don't need to sort of be Warren Buffett to get some of the big ideas with investing. And carries you a long way. And I actually I'll double down on that point too, because I think as most of us as investors, unless you're very hyper specialized, like that generalization that's a real skill set, right? Because you can bring together different threads, and it's like, here's a company that's ostensibly a software development company doing this, but when you can sort of hang that onto some, I don't know, network theory, some game theory, some economics, some, a sense of the business model, like those disciplines compound and reinforce each other in pretty powerful ways. So I think you want to be a generalist. I think that's probably now that I'm saying it, I think that's probably the key weakness of the analyst class, is that they're very smart people. They've done all the degrees and stuff, but that's what they've done. That's what they've done. They've done finance. They've not done anything else. So and it's a weakness, I think.
And you need to be willing to look stupid to learn, right? You have to be willing to look dumb to learn something new. So yeah, I think that's it. I think you do need to be aware as generalists that you're not like the patsy at the poker table, so you need, I think, just being really aware that like if you're looking at a new area, like say that you went to go and invest in semiconductors because you had a thesis about AI, and say that it was 2 years ago before everyone else is, now you're pretty mainstream doing that. But you would go in there just being aware that you're a generalist and being aware there's probably a lot of pitfalls that you need to be aware, not overconfident on pretty much. But at the same time, being a generalist, being able to kind of hop around, you can kind of come into these industries just when they are in a sweet spot, when all the people who are like lifers there might be annoyed with you. But I think you can do really well, frankly, as long as you're conscious of it and you're like aware that there are people who know more than you and be like learn from them.
Yes.
I think it can be a good way to, and it's very fun. It's just what better thing to do than to learn like all these different things about the world and then try and apply them.
Honestly, man, I might have said it before, but I think that's always been the appeal to me for investing. I mean, you come for the money, right? But you sort of stay for the intellectual curiosity, because it's not just about spreadsheets and revenue forecasts and that. It's sort of like more, it's the fundamentals of the fundamentals fascinate me. Is like, this is really just a collection of people that are cooperating in a way where the capital that they have at their disposal, they spin out far more than they put in. Like, how's that? Like boil it down and explain it to me like an 8-year-old. How are you able to do that? And why should I expect you to continue to do that? Okay, then I'll get to the spreadsheet, the numbers and the forecasts and all that kind of stuff. But it's sort of like, I always, whenever we speak to management, I always start out really dumb. A, because I'm not that smart, but B, because I kind of feel like without that base, I mean, everything else lacks context, and everything else is almost meaningless without that really simplistic explanation of like, what do you actually do that solves a problem for your customers, and how can you do it in a way that's so much better than other people, and why can you keep doing that? It's like, if you can't answer those questions, then just stop. And by the way, plenty of stuff comes across my desk. I don't get past that, and it's like, and I'm happy to, right? I'm happy to go pass. I just don't get it.
I was listening to a call the other day. I don't know if one of the ones that you did, but the questions that you asked and the community asked on Strawman are just so much better than the typical call. Like I would have done 5 broker calls for that same company. I can't remember which one it was. And the questions you guys is just like, you actually ask the right questions, you know?
I've got no fear of looking dumb because
No, but that's it. No, that's literally it. Like the analysts are all the opposite, right? They all need to
they don't want to say
strip their credentials to each other and ask really nitpicky little stupid. I mean, they seem smart questions, but they're really dumb questions to ask because they're not the obvious question. I noticed it also on like a broker call or a earnings call for a big company that had maybe 50 analyst calls. 20 of them were about one topic, like a minutiae of a topic. The best two questions on it were from individual investors who called in and like asked something about international growth. Like something asked just really obvious, simple questions. But yeah, no, straw man, not just saying it, but very good, very high quality because you're actually asking the real, the full picture questions, not just the niche in the weeds stuff. So yeah.
Well, thanks, man. But it's interesting too because it gives the responder a general question gives them a lot of direction to go in. And the direction that they choose can be a bit of a tell as well, right? So it's like when you ask those very broad questions, the way they choose to sort of emphasize the key points is it's like, oh, okay, well, that's how you see it. Do you know what I'm getting at here? It's sort of because you could ask a broad question. It could be answered in a dozen different ways. And it's like, they're all informative, but just the fact that you chose to go in a certain direction can be interesting as well. It's sort of that idea of give someone enough rope. Well, if I give you a hyper-specific question, you give me a hyper-specific answer. Whereas if I just let you talk, oftentimes it's like, I never would have thought to ask that. And I didn't really think this was I wasn't getting at this with part of the original question, but you've gone in a very interesting direction. That's sort of, I don't know, that can be interesting too. Occasionally when you do ask the dumb questions, you can pick up on a bit of a tone of frustration with management. Yeah. Well, maybe it's all in my head, but I do find that as grinds my gears a little bit because I feel as though even if it is a dumb question, and maybe it is, it's like, well, this is your job, buddy. If this is too beneath you to explain, it's sort of like, it says something about the character. I don't know if that necessarily has any great inference on the likely success of the business, but it's sort of on the other end of the spectrum, you get those CEOs as like, I am infinitely patient. I totally get that that's not obvious, and let me explain to you. And that to me is just sort of like, oh, I like that.
Yeah, 100%, man. Let's wrap up. And something to be grateful for, you just prompted me, which is, I might have said it before, but basically being able to do investing for a living because it is just such infinite intellectual curiosity. I think it's a really fascinating way to learn about the world. So I was actually down at an industry conference for a particular industry this week and just deep diving into all the different nuances of business models and stuff. I think it's really cool. So that's my bit of gratitude.
Yeah. Isn't that true? Yourself? I think that in whatever it is that sort of, floats your boat, I think anyone who's got an opportunity to do something that they enjoy and earn money is just like, that is a thing of beauty. So yeah, can I go with that too? Or have you taken that one? I like that one.
No, okay. You can maybe reword it. So I don't know. No, we'll have this. We can have the same one.
Yeah, I guess I'm really grateful for, I don't want to repeat myself, but I'm really grateful to be in a more secure situation, housing wise.
To not have a landlord. Claude sent through some good news during the week, which was a 9-year-old girl just buying her first rental property. And I said, how painful would it be to have a flat inspection from a 9-year-old?
Oh man.
So yeah, you're off the treadmill, Andrew.
I'll tell you a quick anecdote. So one of the many houses that we rented in the last 10 years, there was one who was not 9 years old, but like 22 years old.
Yeah.
And he'd bought the house. He was managing it all himself as well, which was, sometimes fun. you bristle at dealing with real estate agents, but then you think, well, maybe there's a role there. But when he first came in, mum and dad were behind him. It was like, it's his first investment property. We're so proud of him. It was like, I've got no buy-in here. I don't care, right? And it was just sort of like, and this kid he's 20 years younger than me at the time. And I just remember thinking, good for you, pal. I'm so happy for you.
Anyway, let's focus on the positive, Andrew. You're out of it. Out of it. You've got a secure, beautiful place that you love. So very cool.
Got a very, very quick one as well. Because this is that was the last rental, we just dropped the keys and left. And the agent sending me through some pictures of weeds, and I was like, dude, we are done. Goodbye and good luck. I'll see you in court if you want to.
This is your quitting.
Yeah, I am not driving back there to pull a bloody weed out of your $10 million property. Like, just deal with it. Jesus.
All right, excellent. All right, until next time, you can hit us up on Twitter at BabyGiantsPod. And until next time, thanks very much for listening.
Yeah, cheers.